Good morning, everybody. It is January 24th, 2020, and I am Kirk Spano, Fundamental Trends, Margin of Safety Investing, and my investment firm, Blue Mound Asset Management. And today we're going to hopefully scare you into selling some things and getting rid of your FOMO, which is fear of missing out, and hopefully give you some fogyak, which is a fear of getting your ass kicked. Because this stock market is overheated for no apparent reason other than the Federal Reserve has been bailing out the repo market, and we will show some correlations there. There is an idea in the world that we will be talking about, or that we'll be seeing the economy heat up and catch up with valuations, and I think that that is very unlikely. The IMF has pointed that out, but hope prevails. And so the stock market is marking everything up to historic valuations again, and nobody seems to care what their assets are really worth. There's a guy in Omaha that does, and he has the highest level of cash that he's ever carried before. So sell almost everything, not everything, but almost everything. We are looking to raise our cash levels from approaching 50% to, if you are a conservative investor, you should be up around 75% cash levels. So while Ray Dalio might say cash is trash, he has the ability to invest in things that you don't. So the idea that you should just keep chasing things up because a hedge fund manager thinks you should, keep in mind that everybody talks their book, especially when they have a lot of money on the line. Nobody would listen to me if I talked my book. So keep that in mind too. Nobody listens to Kirk, but they listen to Ray Dalio. And Ray Dalio is saying keep pounding money into the markets, apparently. I'm not so sure that's a great idea, especially if a 20 to 30% correction would hurt you. And if a 40-50% correction would really hurt you, because both of those things are likely to happen this year. So why should we sell almost everything other than valuations? The slow growth forever global economy never went away, and we will talk about that and review something that we've been following along for over 4 years now. Central bank monetary policy has propped up assets, but not growth. And once again, asset valuations are at historic highs. How high? Pretty high. So these are the valuations of the stock market, various presentations. The PE, the 10-year PE, the Q ratio, which is essentially what Warren Buffett uses, and then the S&P composite from its regression, so using averages. I will focus on the Q ratio here. It's basically the replacement value of the stocks, of the companies, of the stocks in the S&P 500. What that means is, does it make more sense to buy a company if you want to be in that business, or should you just start from scratch? Well, at this point, you'd be paying 144% premium based on Warren Buffett's favorite measure for a business. So the question is, if you were going to start a business, if you wanted to be in a business, and let's hold time, your time aside, would it make sense to spend the money to start the business, or should you just buy an existing business? Well, the average business, you're paying $1.44 for every dollar. Doesn't seem like that big of a deal, except that most businesses don't cost a buck. So we're looking at a 44% premium, and this is what Warren Buffett says we should pay attention to. Crespons's arithmetic mean is similar. The cyclical PE 10, basically the Shiller PE is down here. And what is the Shiller PE? That gets a lot of press, a lot of people criticizing it. Oh, the Shiller PE says that we should sell. That's not what it does. The Shiller PE is basically projecting out what your expected return should be over the next 10 years. So if you buy down here, your expected returns over the next 10 years will be pretty good. And in fact, the 1920s were what? The roaring 20s. And the stock market went straight up. If you bought here, start of the massive bull market. If you bought here, tripled your money. When you buy up here, your returns over the next decade or so probably aren't going to be so hot. So one of my predictions is that the 2020s will be a lot like the 2000s. So that 2000 to 2009 period, I think that's what the 2020 to 2029 period is going to be like. We are going to get more volatility, and we're going to see a bifurcation of the economy. Your old economy stocks are going to get crushed as the baby boomers trickle out of those and the millennials don't buy them. And your tech and new economy stocks are going to be the ones that come back strong after any correction, because the millennials buy them and the baby boomers, they don't do anything, so they don't matter there. So the money trickling out is generally either indexed or old economy stocks, because older people own them. And the new economy stocks, which is what the millennials believe in, and they're right to believe in these, are what are going to get pushed up. So if you're holding on to the notion that Altria or Exxon or a bunch of the banks are going to be the place to be in the next decade, you're going to be sadly mistaken. Look at the valuations, and we'll look at some banks here in a minute, and you will find that there is no logical reason why anybody in America should own a bank stock. None, zero. Maybe some of the little small regional banks if you understand their business, right? There's been some dairy banks in Wisconsin that tripled and quadrupled in the last couple decades. Why? Because they were sitting on mountains of money at a time when people needed money. But in general, banks carry huge economic risks that other companies don't. So one of the stocks we'll look at today, Apple, which about a year and a half ago, 2 years ago, I said, if you want a bank, buy Apple. Why? Because they have more money than any of the banks and a fraction of the liabilities. And they're buying back shares, and they're paying out a dividend. So people, Apple's dividend is only 1% or 1.5%. I can get 3 or 4% on a bank stock. Okay, we'll do a comparison. Don't own bank stocks, pretty much ever. Not unless interest rates normalize, and I don't believe we're going to see interest rates normalize until we see helicopter money. And who knows when that'll be. I suspect at the end of the decade. And I'll explain helicopter money again. So here is the relationship between the Fed's balance sheet and the stock market since the Great Recession. I keep this chart on my Fed graphs, and what we'll see is that the bailouts occurred, and that started driving the stock market up. They stopped expanding their balance sheet, and what happened? We got a flat period in the stock market. Trump gets elected, and we do $1 trillion tax cut to the wealthy, which created $1 trillion deficit. And I will point this out. If you go back to 1981, when Ronald Reagan started cutting taxes for the rich, and George W. Bush did it, and now Trump has done it, what you will find is that the accumulated debt of the United States is almost exactly the same since 1981 as the cumulative amount of tax cuts. And we know that the tax cuts go 80 to 90% to the top 1 or 2% of the population. So there has been a transfer of wealth from the other 99% to the 1%, and it's been driven by tax cuts that created a federal debt that we are all liable for. Think that through when you carry water for tax cuts for the wealthy. And you can say all you want, hey, I got a tax cut of $872 or $3,022 as well. You can say that, but you're going to get inflation at some point. Most costs pass through to you. So unless you were really making a lot of money on these tax cuts, I got like I got over $9,000 last year. You should think through whether or not it makes sense that we run massive deficits that primarily benefit really the 1%. And that next 9% also benefits, and most of us who are listening to this call are in the top 10%. But very few of us are 1%ers. Several of us are close, several of us are there. But the most part, we're in, from the 99th down to the 90th percentile. And then there's some that are in the 80s and 70s who are trying to get started. So think about it ethically. Think about it from the standpoint of, what does that do to the social structure of the country? Does that end up giving me more costs in the future for other things? Law enforcement, court systems, people burning my neighborhood down. Think it through, because it doesn't seem to make any sense to me, as a guy who's doing all right, that the tax cuts that have gone to create multi-millionaires and billionaires should drive up the federal debt for 40 years now. Why should somebody like Jamie Dimon, who materially participated in the crash of the economy, become a billionaire? I'm not a big Bernie Sanders guy. I think that he'd screw things up a different way. But he's right when he says that all these bankers that we bailed out and we didn't send any of them to jail, even though I'm in the financial industry, I knew that they were stealing, so they must have known they were stealing. None of them went to jail. None of them even lost their jobs, really. We threw Lehman Brothers on the altar, made the sacrifice to Odin, and now everybody else is fat and dumb and happy. And we are living in an illusion if we think that the Federal Reserve can just keep on propping up the markets. Look right here at the end. Jerome Powell has said this was temporary. Now, I suspect that he just moved sideways now. I don't think he's going to reduce the balance sheet. I don't think that he can. If we see this curve turn over, if we see the Fed start to reduce their balance sheet, we're going to get another Q4 2018 style correction. Again, valuations are high. They've gotten there because the Fed printed a ton of money. And then we got a massive tax break right after oil prices went down. And oil prices are becoming less important on the low side. But if they go higher, that's a problem. So what is the Fed going to do right here? Can they just keep printing money? Would they dare go through this line? All right. So where does this all come from? Back in 2016 and 2015 on Market Watch, I was talking about something called the slow growth forever global economy. If you've listened to Larry Summers, Democrat, or if you've listened to Neil Kashkari, Republican, they both say essentially the same thing. There are structural problems in the economy. If you go to Blue Mountain Asset Management, my investment firm website, you can read this in its entirety. We talk about the same things over and over again. Aging demographics are the biggest driver of the economy. More people spending money, entering the middle class, the more growth in the economy. The fewer people spending money, slower growth in the economy. And we are running into major aging problems. Japan is the oldest population on the planet, and they've been stuck in a secular stagnation for 30 years now, 3 decades. They're the 4th biggest economy. Europe and China are right behind Japan for aging. 2nd and 3rd biggest economies. The United States, as we've discussed, we have the millennials to offset the boomers, but they're not adding any new growth. They're just offsetting the reduction in growth from the boomers retiring. So the United States is relatively better than all these other places. And I would certainly invest most of my money in the United States versus those other places, because the dollar eventually is going to skyrocket. And that's going to crush assets everywhere around the world. And we probably will see a much stronger dollar by the end of the year. We don't want to be in a position where we buy into the hype that we should be, have 40, 50, 60% of our money overseas. There's an argument for having 5, 10, 15, 20% of your money overseas, but the reality, and Buffett says this all the time, is America is the best place to invest, especially for Americans, but even for people around the world. I'm going to be reaching out to the Chinese imminently, and probably Indians imminently, via different publications, how they can invest in the United States, because this is the place to invest. The problem is that we're running a massive deficit. The Chinese and Japanese aren't buying our bonds anymore, and that's part of the reason why the repo market had to get bailed out. That, and there are at least 3 institutions that I identified that had massive outflows last year, which means that they may have had to unwind their leverage. So I'm pretty sure, and nobody knows, but I'm pretty sure the evidence points to, the breadcrumbs point to, there were 2 or 3 financial institutions that had to unwind a lot of leverage. And had they done that without the help of the Federal Reserve giving them cash to help them do it, you would have seen a massive crash in the economy and the stock market. Stock market first, probably economy to follow. Usually it's the economy first and then the stock market, but sometimes the stock market will lead. And if firms, and I'll mention one because I think they're the most likely to me, AQR, if these firms would have had to unwind leveraged bets into the hundreds of billions and maybe $1 trillion, think about that money coming out of the stock market. Think about a giant hundreds of billions of dollars worth of margin calls. That would have crushed things. So the Federal Reserve printed about $500 billion, and again, we use the word printed lightly. They created more debt. I think that we actually should just print money, but they borrowed it instead, and they increased their balance sheet like I showed you a minute ago. And that is all derivative of these growth problems. Global debt, I haven't updated this in a world, but global debt is much higher now. Productivity never boomed. So all these things that we talked about 4 years ago that we should watch, it turns out that none of them got better. But assets are higher. Okay. But assets were higher in 2007 as well, and in 1999. I'm not saying that we get that type of an event, but it could be pretty significant. Hence, my game plan, my outlook and game plan, where I told folks, hey, depending on how conservative you are, how aggressive you are, you want to be somewhere between 50 and 75% cash in the first quarter of this year. I believe that you really ought to be rounding up as quickly as possible, because we're probably getting to the blow-off top. And I will speculate that when President Trump gets acquitted, which is, there's only one scenario where he doesn't, That probably marks the top of the market, somewhere in that, within a short period of time around that. The only scenario where Trump gets removed from office is if they allow more witnesses. And why would that happen? Right now, they can vote on the evidence they have and say, he probably did some things wrong, but it's not impeachable. I mean, that's really the story you're getting. If they introduce more witnesses, if Bolton testifies, some of the other folks, Mulvaney, some others, the Russian guy from Florida, if they actually testify, that could bring up new evidence, and then senators might not have a choice but to vote for removal. That's why they're fighting introducing new witnesses. That's why they don't want those witnesses there, because that might put them on the spot. Right now, they can make the rhetorical arguments they're making to prevent Trump from getting removed. I don't know what the new evidence would be. Maybe it's not damaging, maybe it is, but better not to hear it. So I suspect they don't allow witnesses. I think they miss by a vote. Trump gets acquitted, and the stock market rallies, and that should be your sell the news moment. Because these valuations are so obnoxious that anybody who thinks this can go on is living in fantasy land. And I think a lot of millennials are going to take it in the chin, because they don't remember 2007. They don't remember 1999 and what came after both of those periods. The Federal Reserve can't prop these markets up forever. Even in Japan and in Europe, where they've been doing these policies longer and more extreme, they weren't able to keep the markets up after a while. Markets are a matter of confidence. And if the central banks have to keep bailing, you have to think that enough people lose confidence at some point. And if we don't get new investors into the market, who's going to buy those shares as the pension funds and the boomers continue to trickle money out? I've shown those charts. I believe there is one in here. Maybe not. Here we go. Pensions and boomers will continue to sell in 2020. So the charts are right there. I've had people argue with me that the boomers aren't really selling their stocks. The evidence would indicate otherwise. That's what's happening. The pensions have to sell because they have to pay those checks out. The public pensions are about $6 trillion short, which means by the end of the decade, they need a bailout. The private pensions are about roughly correctly funded, and only a couple percentage points short. So if there's a big stock market correction, they'd have to worry about being 10 or 15% short. But they've also been trickling out as they pay their pensions, and they offer buyouts, right? The pension funds are trying to buy people out because they don't want to have to pay these checks out in case people live an extra 10 years past their life expectancy, which is the trend. So we've taken a look at valuations. We're trying to understand the slow growth forever global economy. Let's look at some real world examples. This is the S&P 500. It is overbought on the RSI. That always indicates a correction is imminent. And we can see that the money flow has been rising, not only very recently, but on the weekly chart. The monthly chart, not so hot though. This is all it could muster up, even with the Federal Reserve. So think about the forces that are preventing the entire market to participate in this rally. So let's take a look at who is participating. Primarily the tech stocks, very overvalued. right? Money flowing into those, the millennials, right? These are the stocks that they're going to believe in. These are the ones they're going to invest in. The daily chart holding up. The Federal Reserve just started to whinny away, started to level things off. The monthly, even with $500 billion going into the markets and to the economy from the Federal Reserve, and a lot of that ends up just going to sit on bank balance sheets, but it prevented the money getting sucked out, right? That reverse effect. If you prevent the suck out, if you prevent money from getting sucked out, you've essentially added money. So even with all that money going into onto the Fed balance sheet, the rally hasn't been that impressive for money flow, but we still are getting the really high short-term bump. Does that make sense to you? This is all valuation expansion because profits have only grown a couple percent in the last year and probably only grow a couple percent in the next year, or they fall. So this is the S&P 500. Let's take a look at all the stocks that are overbought. Look at those. And we can just keep going. So you had over 100 stocks that were overbought. And then another 100 and change that are almost overbought. Some of them are just getting there. Some of them are just coming off. Over half the stock market is overbought or approaching overbought. RSIs. If RSI is over 70, be careful. 60s should make you watch real closely. So let's take a look at the biggest companies. The biggest companies drive the stock market, correct? Because these are market cap weighted indexes. So your $1 trillion companies are driving the stock market. Your really big companies are driving the stock market. Let's just go in order. Apple, overbought, straight up. This is on the weekly chart. It's been going up a long time. Even on the monthly and on the daily. And I'll tell you a secret about Apple, and I'm going to write an article about this. Apple is the source of liquidity for Berkshire Hathaway. Berkshire Hathaway is one of the biggest stocks in the market. I think it's 10th or something. We'll see. We can go right back and we can check. All right, Berkshire Hathaway, 1, 2, 3, 6th. 1, 2, 3, 4, 5th. 5th biggest. Berkshire Hathaway owns other stocks. They need to invest in big companies, otherwise they impact the liquidity of those other stocks. Berkshire Hathaway has been selling about $1 billion a month worth of Apple stock, apparently going back to about May. Sold $3 billion one quarter. I think there was one quarter they only sold $1 billion, but I suspect they're selling more now. Buffett said when Apple was approaching 200, we're not buying it anymore. And then we found out a few months later that they had started to sell it. Berkshire Hathaway has about $130 billion in cash and short-term assets, which is the most they've ever had. And I read somewhere they had closer to $170 billion. So I'll double check on that. But this should make you scared. And in fact, Apple retracing all the way down to the middle 200s, right? Let's suppose that this is the new support. And this level in here could be the new support. Look at how it got up to there, had a hard time, got above, but then broke back below, which is an indicator that this isn't the support. Came back and touched it again. My guess is that support for Apple is really down around $200 a share. Will we get there? I don't know. Maybe it only gets down to, here, 230-ish. but somewhere between 200 and 230 is realistic for Apple. Why? Because it's not as if their earnings have grown all that much. This is all valuation expansion. When charts look like this, you need to ask some questions. Microsoft, pretty easy to get it down to 136. Very possible it gets down to the low 100s. Think about what kind of percentages these are. Now, I have said that Facebook has real business problems. A lot of people disagree with me. I think that they get back down here again. This is a support level that I think you need to be aware of for Facebook. I think Facebook gets down into the 120s again. Amazon. Having just returned from CES, I will tell you that all things are Amazon, and they're almost positively going to spin off AWS. Keep everything, all the businesses that sell something on one side, then spin off AWS on the other side. If you can get Amazon in this area, right, 1400s, 1500, probably want to buy it. This is one of the only must-own stocks on my list. Got like 11 of them, 12 of them. This is one of them. Google is another one. Berkshire Hathaway, chopping along for a long time. You know, anywhere in this range, you could probably buy Berkshire Hathaway, but you're never going to get a lot of growth out of them. All it is a piggy bank that doesn't pay a dividend. I do think that some of the things they've done for the future, though, are pretty amazing. And after Warren Buffett is gone, his ghost is going to say, see, I told you it was going to work out. So Berkshire Hathaway, for folks who are conservative, if it ever does get a real market valuation, if it can get down to this 150, 60 area, I think you got to load up on it, because their cash is going to be useful whenever the next correction comes. They will be able to buy some cherries. One of the reasons that I invested in Travel America, TA, was because these guys bought Pilot. Why did Buffett buy a truck stop chain? It has to do with the future of mobility. Travel America is going to benefit from that too. Visa, popping up like that. It was probably already overvalued in here, and it went up again. Easy down into the 170s. JP Morgan. Here's one that I think you really ought to think clearly about. To think that it can't get down into the 70s, maybe think again. When you stretch these charts out, start asking yourself a question. What really happened in here? And it was the massive corporate tax cuts. And now the Federal Reserve bailed somebody out. What should JP Morgan really be trading for? I would argue in the 70s. That's what it's really worth. Walmart, who knows if they can ever grow. Stretch their chart out. You know, and this is with Berkshire Hathaway as a shareholder. I don't think there's anything sexy about Walmart. I find it hard to believe that people who are going to do an online search using Amazon or Shopify or whoever they're going to use are going to end up buying from Walmart. So this is just a staple company to me. It's not really a cyclical. It's just going to chop around forever. I don't have any faith in their online business. MasterCard, same as Visa. Procter & Gamble, this doesn't make any goddamn sense. You know, it doesn't make any sense at all. This is a stock that could get all the way down to 75 again. I mean, seriously, if you know anything about Procter & Gamble, they haven't had any growth for a decade. and they have a lot more competition, and the Costco's of the world keep pushing their margins down. Bank of America, these guys could end up way down here at 17, 18, 19, 20 again. This one could easily get cut in half. United Health Group, I think that this stock should be down around 100. I think that this is the level they belong. I think that everything in here is imaginary. This is people saying, oh, but the boomers need health care. Yeah. But the United States budget needs a little bit less health care, right? We can't pay for the rates that they what they get. Exxon, clearly the long-term trend is down. I don't think this ever really gets better. I think they continue to chop along, even with higher oil prices in the next couple of years, presuming that happens. If you want oil stocks, stick with the Permian stocks, stick with Pioneer, stick with Parsley, Occidental if you want a leveraged play, Encana, Devon Energy. There's a handful. But Pioneer and Parsley are probably the two best now that they are both Permian pure plays. AT&T, now because of their business model, and you need to think this through, what do they become? I have said, now they're back towards the top of their range, I have said that they ultimately have a new higher range. To me, these guys probably get back into the mid-30s. They lose $3, $4, $5. You should buy it. Why? Well, big fat dividend doesn't hurt, right? But if you think about their business, they're using Warner Entertainment to capture more subscribers, but cell phones is really a churn business. So it's really their 5G, which they have an advantage on because they have a global network of the underlying fiber. AT&T's got some big advantages on the 5G side, which we've talked about in recent seminars. So this is one that I think you can buy back in the low to mid 30s. And ultimately, I think they're going to sell Warner Brothers and get an awful lot of money for it. Intel spiking up, which is something that I have a bet on with somebody from a year or two ago. Now, I will tell you this. Their mobility solution, Mobileye, I don't think it's going to be that big of a deal. I think that Tesla, I think Elon Musk is right that LiDAR is not the solution. And I don't think that Intel necessarily is in the right spot here. So this pop here, if you own Intel, sell it now. Stop listening, go sell it now. Walt Disney. This is a company I'd like to figure out a way to own. Right in here is your supports. So 100 and teens, probably where you want to buy it. But again, look, things like this don't make sense. They haven't realized really any revenue yet, and they have massive expenses. Content costs money. But I do really like their franchise. This under 120 is probably a must buy. Home Depot, this company just keeps churning upwards. If you want a proxy for the S&P 500, I think this is one. I think there's a big building boom in the 2020s, 2030s. You get this down in the 170s, 180s, it's probably worthwhile to buy. Now, if we have a massive correlated correction that also has that's paired up with a recession, there are lower levels here too. I mean, you could get this stock under 100. And if you can, keep this in the back of your head. If you can ever get Home Depot for around 100, you should buy it. Because people are going to keep fixing up their houses. It's perpetual, right? You can't stop fixing up your house. You can let it sit for a few years, but eventually you need something. Verizon, I don't like as much as AT&T because they don't have the giant Warner Brother asset to sell off, and their fiber network, other than out east, isn't as good. Coca-Cola, are they really going to make a lot of money selling water and other beverages? I don't know. I think that the beverage market is starting to spread out again. I think this is probably a stock that comes back into the 40s. Even there, I don't think that I personally want to own it. I can get whatever part of this I need through any indexes I have. Merck & Company. Good franchises, but realistically, because of R&D expenses, you shouldn't really pay more than 60 something a share for it. Pfizer, same thing, 30 something a share. Chevron eventually goes into oblivion and splits off some of its real estate and other assets. They've already started, by the way. Cisco, this is one of my favorites. I like this box. I think it showed up here what it can do. So I think any dips in Cisco into the 40s, lower 40s, pretty much buy. I think this holds. They're a big part of the 5G revolution. Nestle, meh. What have they done for me? Got a rally here lately. Sell Nestle and probably never buy it back. Netflix, chopping along here. Why? Lots of new competition. Telling you, Netflix is going to have a problem in the future. I love Netflix, but I think it's a under $250 stock. Maybe all the way down to 150. Take a look at that. Take a look at this level here. These levels are important. These are consolidation levels. This is where somebody big was picking up shares, and then it took off when the chasers chased. And now it's a trading stock. Could it go all the way into the middle 100s? It could. Middle 200s for sure. Do you want it in the middle 300s, knowing that middle 200s and the middle 100s are very good possibilities? I don't. And at some point, Mark Cuban's going to back off of this stock. He just said he's not seen anything yet to sell Netflix, which means he's looking for something to sell. Don't sell after him. And then we'll finish with Wisconsin Electric. I'm in Wisconsin. I know this company inside and out. You know what I know? They have coal-fired power plants here that they have to do something with, and it's going to be really expensive. The utility rally for the last year and a half has been great. I know somebody who predicted it, and they were right, and I should have jumped on. Dominion was the only thing that we owned for a while. But look at this. This is the support levels way down here in the 70s. So how, if you're a utility investor, do you feel if your $100 stock falls into the 70s? I mean, I'd probably buy it down here around 70. I don't want it around 100. Who's going to buy it for me at 100? You better sell it now while the Fed's got money in the system. And while the indexes are getting filled with retirement plan money. That's what the January effect is. That's what the Santa Claus rally is. It's retirement plan money coming into the system. Short-term in nature. It starts to trickle off in the next couple of weeks. All right. So we're going to end the presentation today, and I just want to talk about what's coming forward. As I mentioned at the start, questions and answers will be off the air here. But I do have the ability to put videos behind the firewalls at the investment letters, and I will start doing that. So use the Ask Me Anything threads, and I will do little private 2-minute, 3-minute videos and start popping them up on the services. So if you have a question about our stocks, ask me, and I'll either do them at the end of this presentation, but I won't put them on YouTube, and or I'll do them just on my own time, and then I'll pop them up. All right, everybody have a great weekend. I hope that you're a net seller. You should be looking to preserve your wealth right now. Sometimes a return of principal makes more sense than a return on principal. We're getting into the toppy part of this market. I don't think there's any doubts. And if you do still have doubt, just keep coming back. Let's see here. Oh, I'm trying to pop up the slideshow one more time. View. There we go. Resume slideshow. It doesn't want to show me. Let's do this. There. Here you go. Remember this chart. Go to Advisor Perspectives every month and check this out. Go to Advisor Perspectives every month and check this out. We're not quite as bad as 1999. We're actually way higher than where we were in 2007. Expect these to come back down at least into this area. It's a pretty big drop. Somewhere between a 20-ish and 50-ish% drop in the stock market this year, probably. And there's a possibility that we give back the entire Trump rally. I don't think we quite give it all back, but we could give most of it back. If holding on to your wealth makes a difference to you, then hold on to it. All right, have a great weekend.